It's yet another season of monetary policy announcements as African central banks hold their last meeting for the year this week into next week. We'll bring you some of the outcomes so far this week, while also looking at stories from the just concluded B20 summit in Johannesburg, the first time it's happening in South Africa. Hello and welcome to Africa Business Weekly. I'm your host, Akin Obakeye. Let's dive into this week's discussion as we join Karabo, who's waiting to give us fillers from the city of Johannesburg. It's over to you, Karabo.
Hello, Akin. Well, in a landmark moment for Africa, the B20 summit, held for the first time in Johannesburg, South Africa, served as a platform for key business leaders to emphasize the opportunities and potential for growth within the continent. Mary Vilakazi, CEO of FirstRand Group, joined CNBC Africa's Godfrey Mutizwa to discuss her insights and expectations around Africa's investment case and the outcomes of the summit.
I think as a country, as the business community, because I've been involved in the work streams on the B20 side, and as a business community, I think we have shown up well. It's been a good platform to actually have very focused engagement on topics and areas of growth for the continent. I mean, a lot of these topics are not new. How do we improve financing of infrastructure? How do we bring down the cost of capital so that, I think African countries can grow and thrive? Yeah. How do we improve resilience, focusing on food security and the climate change issues. So these are topics that would have happened anyway. Yeah. But I think to have been able to leverage of the global network, I think a lot of South African businesses have been involved in this. That's been good. And I really hope some of the recommendations that we've made in the different work streams will be taken on board by the G20. And I think even if nothing happens, I think the fact that you got together and got alignment on what has to be done. I think that's been positive. But ultimately, the success of this B20 summit and the opportunity we've had to host the G20 in South Africa ultimately will be judged in the long run by jobs created for African people and African businesses. So that's the ultimate test.
Yeah, and as I said earlier, you have been talking. You have also been listening. For you, from at least the discussions of the past couple of days, what have been the key themes that you have followed?
So I guess I was on the trade and industry work stream. So that's quite an important one, because one of the things that we have all been focused on this year is trade tariffs. Yeah. And what that means. And equally, I think getting together with countries from across the world where everybody's really solving for themselves because the global order has changed, as we know. Yeah. And looking at how much African countries trade with each other on the continent. I mean, the fact that it's less than 20% of our trade is within the region is still really, I think, a big disappointment. We've been talking about the Africa Free Continental Trade Area agreements for quite a number of years. Yeah. So that is one agreement, and I think a set of initiatives that I really hope the G20 takes forward. Yeah. I really hope the governments of this country really become serious about it, because if we can unlock trade on the continent, trading with each other, facilitate easier cross-border payments, have our systems interoperable in Africa. Yeah. If you sit in other regions in the world, why should you care about things not working for Africa? We need to take ourselves seriously, prioritize the fact that we've got natural resources. Yeah. We've got the people. Yeah. And we actually can unlock a lot of growth for each other through, I think, through trade, actually. So I think that's, for me, really a key area where, with the fragmentation of supply chains across the world, I think we have a very big opportunity.
And at a last meeting for 2025, the South African Reserve Bank cut interest rates by 25 basis points. The repo rate now stands at 6.75%. The decision was unanimous, and in the question and answer session, Governor Lesetja Kganyago said that no 50 basis point cut was put on the table. This decision comes a day after we saw inflation ticking up to 3.6% in October. Now, Now, to unpack this decision and what could be next, CNBC Africa spoke to Matthew Ryan, head of market strategy at Ebury.
I think we see sort of mixed implications for financial markets from the decision. I would say that the announcement probably leaned slightly more towards the dovish side. Right off the bat, as you said, we received a 25 basis point rate cut, which was the consensus view among economists and market forecasters such as ourselves, but it wasn't quite fully priced in by financial markets. And not only that, again, as you mentioned, we did see a unanimous vote. We actually went into the meeting expecting perhaps even a couple of dissenters in favour of no change. I say that primarily given the element of uncertainty surrounding inflation, particularly the headline number, which is now back up towards the upper end of the band and the highest level in over a year. But on the other hand, I mean, the Reserve Bank did strike a slightly more upbeat tone on the growth outlook, and more so than we anticipated. They said that growth had been steadier than last year, and they also upped their growth forecast for 2025, even though it was only a modest change. And they continue to see expansion of around 2%, which again, slightly more upbeat than we anticipated. So I guess there was something for everyone really in the communications, and I think that can largely explain the muted reaction that we've seen, at least in the South African rand.
On a possible scenario of a 50 basis point cut, considering what the governor said about the drivers of inflation, he said that, of course, we got the 3.6% in October. He said that inflation is up because of non-core categories, and that food price inflation seems to have peaked, and that there are now downward revisions to the inflation outlook. Looking at it at face value, I would say that maybe could have favored a 50 basis point cut. But was there no room for a more aggressive cut, also considering the fact that they have this 3% target? Is it the 3% target that maybe restricted the SARB from going further for a jumbo cut?
Yeah, I mean, I think that was a key aspect of the communications, the fact that the 50 basis point cut wasn't even considered. It's somewhat hawkish, I would say that, but it wasn't something that we realistically had in our sort of base case scenario. I think it's interesting because, you know, we have a little bit of a dichotomy on the one hand with headline inflation, which is up the upper end of the band, but core inflation, which strips out the volatile components, that seems to be slightly more well anchored. And I think there are some possible downside risks to inflation, particularly if you look at the value of the rand, which has been quite strong in the last few months, and the fact that we've seen slightly lower commodity prices, particularly oil prices, which tends to put some downside pressure on inflation. I think the introduction of this new band is an interesting development. Actually, it's a little bit of a double-edged sword, I would say, because, you know, on the one hand, it should bring down inflation expectations and yields, and also act as a sort of de facto easing in itself. But on the other hand, SARB needs to sort of convey to markets that it's serious in meeting this target, which perhaps requires more easing. So it's a difficult balancing act, I think, at the moment. A 25 basis point cut probably seems appropriate.
And those were some of the stories making headlines down south of the continent for this week. But until then, it's back to you, Akin.
Thanks, Karabo. Let's join Tabitha now in Kigali as she gives us updates from East Africa.
Hello and good evening. Rwanda's central bank has maintained the base lending rate at 6.75% in its final monetary policy committee meeting for 2025. Market watchers had forecasted a stay on the rate, setting inflationary pressures were within target range. We spoke to the bank's deputy governor, Nick Barije, for more.
Economies are growing, inflation is coming down. When we bring it home, we see the same trend. Our economy is growing. Inflation, as much as it has increased to 7.2, we project that on average at the year end it will be around 6.9, and then it would fall further in 2026 to 5.8. Now that's what informs the decisions, both the monetary policy committee decisions as well as the financial sector policy decisions, where we are now coming out to say we are going to maintain the central bank rate at 6.5%. So all to say it's looking globally. What are we seeing? Are we seeing economies growing? Are we seeing inflation coming down? Regionally, same trend. Domestically, we see the same. So overall, tone of the press conference and what we want to share with members of the public is our economy is growing. Inflation is projected to come down from where it is this month. And as a result of that, that's what is informing the monetary policy decision of maintaining the central bank rate to 6.75.
When you look at the financial sector, it has shown some impressive numbers, from cashless uptake in Rwanda to the asset growth into almost 11 trillion Rwandan francs. Talk to me about the financial sector's promise and what do you see in this area?
We're very excited for the growth that we are seeing. Assets of all financial institutions have grown to 15 trillion. New authorized loans have increased to 1.9 trillion. We are seeing that the sectors overall, when we see loan concentration, manufacturing, construction, services, even agriculture, the loans being lent to those sectors are also increasing. And this is what is also, so the thing is, when the economy is performing well, then the actors are coming to the financial institutions to borrow. And that also leads to the growth of the financial sector. So all indications are the financial sector is performing well, it has sufficient capital buffers, it has liquidity, and even those who are borrowing, because they are performing well, the non-performing ratios are within the rate, even below the central bank rate of 5%. So overall, for us, look at MPC decisions, when we look at FSC decisions, it's good sound note that we are taking away from today.
To more developing news. Now, despite being East Africa's regional leader, Kenya's insurance penetration is just 2.6%, highlighting how most households, businesses, and even individuals across Kenya and Africa remain unprotected against crisis. We spoke to Tom Gitogo, who is the Group MD and CEO of Britam, about what this means for resilience across the continent.
Starting with the individuals, obviously, protests may bring slowness in business and activities, and when that happens, individuals may not necessarily get the revenues that they thrive on. Employment obviously would go down, and generally speaking, even as insurers, there are some risks, some claims that consequentially, arise from these protests. So I would say, on average, obviously there are perhaps political gains from some of the protests, I suppose, but those also come or tag along some economic hardships. That's what I would say.
All right. And are there particular sectors or types of businesses that are more vulnerable, and why?
The protests obviously tend to happen in urban areas, so SMEs that are operating, or even entrepreneurs who are doing their business in township areas or in urban areas get affected. So an SME owner or a proprietor may therefore not necessarily get the level of financing that their business growth requires. Some of their customers, from the economic slowdown, may not be in a position to pay their debts. And the impact that this has on the velocity of money or the circulation of money, impacts them. So if they're seeking funding, for example, if the protests take long or are fairly frequent, then even investors, whether they are foreign direct investors, may adopt a wait-and-see attitude or charge a premium on the interest that these businesses can access funding with.
So in this climate, what do you see as the biggest risks for SMEs and also households?
Well, there are two extremes of climate risk. flooding. We've seen a lot of that happen in Mozambique, Malawi, here in Kenya as well. But there's also drought. In the case of flooding, obviously impacts crop productivity if the farmlands are flooded. And in drought, our pastoralists, our farmers who keep animals are obviously impacted. So as an insurance industry, we obviously need to increase our parametric knowledge so that we can come up with products that shield or at least compensate farmers from some of the, and businesses as well, from some of these climatic changes. The thing with parametric insurance is that it would reduce paperwork. You don't want to complete papers and claim forms when you're barely surviving a flood or a drought. If this can, and if from the comfort of our offices, we can see from data that a certain level of flooding or rainfall has occurred, or there has been extended drought. Really, why do we need the farmers to complete claim forms? We can just pleasantly surprise them, be there on their 11th hour.
Now that's it from the region. Back to you again.
Very insightful conversations. S&P Global Ratings believes Senegal's ability to progress on a new deal with the IMF is crucial to its meeting its maturing foreign currency debt. The Bretton Woods institution, while lowering its sovereign credit ratings to CCC+, has placed the West African nation on credit watch developing and could lower its ratings if the upcoming commercial maturities are not financed. Michael Vidal, director at S&P Global Ratings, broke this down further for us. Take a listen.
It's indeed largely relating to, the advancement in the negotiation with the IMF in a context where Senegal will still have to face very large gross financing requirements for 2026, which represent 26% of GDP. So a very sizable amount. And out of these gross financing requirements, a big part of it is actually foreign currency debt. And that's why we see the ability to advance on an IMF program as key, because to obtain a program with the IMF could potentially unlock a lot of concessional money from, the IMF if there is a funding put in place, but also with other concessional lenders such as the World Bank and concessional lenders in general. So that would really facilitate the ability to face this large gross financing requirements for 2026. That said, at this stage, we still have little visibility on the potential outcome of the negotiations with the IMF. The IMF has to perform what's called its debt sustainability analysis, which will conclude whether they see the debt as sustainable or not, and which could ultimately define the conditions associated with the program. Hence, our decision to lower our rating to CCC+, because there is indeed a scenario where the IMF might conclude that a restructuring is actually needed, which may complicate Senegal's ability to face its gross financing requirements for 2026. So, in a nutshell, that's why we have lowered the rating to CCC+, the foreign currency one.
While we look at the rating action and also the credit watch leasing as well, let's look at the foreign currency debt, 4.6 billion in terms of external debt service. And like what you said in your credit watch, it says the placement signals that you could lower your ratings on Senegal if the government is unable to refinance its upcoming commercial maturities. Let's look at how this debt is and how it would help in terms of coming up with a debt sustainability strategy right now for Senegal. And do you think that there's every possibility where they can reach some agreements with lenders as well in terms of either cancellation or?
Yeah, well, it's in fact, it's a good question. So the 4.6 billion you alluded to is the external debt due for 2026 only. And indeed, the ability to refinance that is a key parameter in our credit watch development assignment, which is a short-term instrument in nature, and that we review every 3 months. The reason why we're looking at that closely is that in March 2026 you'll have a big Eurobond amortization, so the advancements need to move fairly quickly. Now, the credit watch assignment is also it's a nuanced approach, because it also tried to reflect on the other end some positive steps that we've seen over the last 6 months from the Senegalese authorities, which have actually enabled the authorities to face already very large financing requirements for 2025 that represented around 25% of GDP, and to date they've achieved about 70% of that. So that means that they have a strong access to the regional debt market. And that's clearly a benefit of belonging to the WIMU union, basically.
And in Nigeria, the CFG advisory believes the level of rate cut at the November Monetary Policy Committee meeting will be true test and affirmation of the 16.05 inflation figure for October. They note that the statistical inflation drop remains a concern as it does not reflect the reality. Tiluwa Adebajo, CEO of CFG Advisory, shared his perspectives on this.
Current rates of rebasing are just really focusing on what the current levels of inflation is. Obviously, we all agree that there's disinflation. The trajectory of inflation is on the downward trend, even though you might still have some challenges with food inflation. But if you take a look at core inflation, I think that confidence is there, and that's why we saw the 50 basis cut in the last MPC meeting. Having said that, I think these adjustments...
Well, we'll quickly cross over to the Nigerian exchange to take a look at how the local tickers are faring at this moment. Don't go nowhere. And that was a highlight snapshot of trading action at the local burst here. I still have with me Tiluwa Adebajo, the Chief Executive Officer of the CFG Advisory. Thank you once again for your patience. Mr. Adebajo, what do you mean exactly by this statement? The level of rate cut, if any, at this month's MPC will be the true test and affirmation of our inflation print for the month of October?
Well, basically, the current CPI figures are more representative now of what current spending or what current cost is all about. But that doesn't mean that there's been a significant reduction in the cost of living. But we all agree that inflation is on the downward trajectory. I think we all agree that. Something we mustn't also take for granted is the fact that the Naira appreciation, I think, is quite also significant in terms of helping with the stability of the exchange rate. Not only the stability of the Naira, but also its appreciation is also having an impact on helping to drive these rates down. So what is important now is that we all also agree that the economy has reached a point of inflection. Now the issue, we've seen 4.2% growth. So the issue now is how do we get disinflation and sustainable growth? That is really where the trajectory should be right now. So what we're saying is that this MPC meeting is going to be very critical for us to see whether the MPC authorities are confident about the level of these rate cuts to be able to give us close to between a 150 to 200 basis points rate cut. Because looking at how things are now, you need to create a stimulus in the economy. If you can bring the rates down from 27 to 25, that would be quite significant because you can now begin to spur growth. But at the same time, they're still very careful to watch the numbers to ensure that you do not cut rates that maybe early next year, again, they now have to jack the rates up. So that's where the trade-off is right now.
It's definitely clear we're not out of the woods yet, but I would like to ask now, would you say that the current disinflation path is aligned with the CBN's medium-term inflation target? And when we're looking at the impact on foreign portfolio investors and also domestic institutional investors, what does this mean for the near-term outlook?
Well, this year has been quite positive for foreign portfolio investors because there's more transparency and accountability in our markets. In 2019, we had a record $16 billion in foreign portfolio investments. This year, already half year, we'd already exceeded $10 billion. So we're looking to close this year with over $20 billion in foreign portfolio investment, which will be a record high for Nigeria. So I think these are all positive signals for our markets. And I think that we're out of the woods. It's just a question now of how do you manage growth. So it's now a question of how do you manage the alignment of monetary policy, fiscal policy, and more important now, for us to grow the economy, you need to align with industrial policy, trade policy, and investment policy. That slight misalignment you're seeing with the capital gains tax is what has spooked the market over the last 1 week. And those are the sort of alignment that we need to correct so that we can see a positive trajectory of growth.
And over the weekend, Guinea-Bissau heads to the polls as incumbent President Umaru Sissoco Embalo seeks re-election. Now, this is where we draw the curtains on this episode. Thank you for joining on Africa Business Weekly. You can catch all these stories and more on our website at cnbcafrica.com. Until next time, stay informed and stay ahead. I'm Aki Obake.